Hello, everybody. It's Max with Max Financial Services, your gun-friendly financial advisor. Welcome to our first blab. Instead of doing it over a lengthy newsletters, and you guys know I can type for pages and pages or talk for hours and hours, so we're going to do a quick video instead. Every Thursday, we're going to have them scheduled. The primary purpose of these videos is primarily just to update you guys on what happened with the markets, any economic updates, anything else financially related I think you guys should be aware of. Every Tuesday, we're going to be doing a financial planning centered one. So every Tuesday, we're going to discuss a various financial planning topic. And as always, these are going to be available and posted on our website, as well as possibly YouTube through a private link. And if you receive the Blab link, you'll be able to view it directly through Blab at a time you're choosing whenever is going to be convenient for you. So today, I guess kind of let's get started. Over the last 5 days or so, over the last trading week, the markets, both the S&P and the Dow, have actually made quite a good recovery. The S&P is up over 4.25% over the last 5 days. The Dow Jones is up 4.5%. And a lot of it really is it's a recovery off of the sell-off that we've had. Right now, we're really at an interesting point in time, and we'll talk about it in a second. As far as the bonds are concerned, the 10-year bonds are still dirt cheap. They strengthened in value, so the yields and the rates have come down. So currently, the 10-year bond is 2.1%, meaning if you borrow money, if you lend money to the U.S. government, they're willing to pay you 2.1% for the next 10 years. It does seem stupid low, but if you take a look at it from the perspective of other European countries, those are less than 2%, in some cases less than 1%. So even though it's low, I definitely am in the camp that rates can definitely come down even more from where we are. Oil actually had a decent rally today. It closed up a bit, and right now it's at $49.62. It did try to challenge the $50 a barrel mark, however, it failed. A couple of reasons for that. So the primary reason that's given is my native Russians, because we're participating in Syria, and as a whole, that might be destabilizing the Saudi regime down there. So as part of that, it's primary political risk of what may happen. So as such, oil is challenging a little bit higher. Fundamentally, though, the thing that we have to understand is that there's a glut of oil that's out there, and we're producing too much. Russia's producing a lot. The Saudis can keep on pumping. So for the most part, people are expecting that the oil prices are actually going to fall over time. They are going to keep challenging the $50 mark, so we'll see what happens. There's two components that really go into it as well. If we do have a weaker dollar, the price of oil may actually go up and will likely go up. But if we have a stronger dollar, because most of the commodities are priced in dollars, the price of oil may actually come down. Now, as far as basically what's been happening, we did have a rally. I mean, we're pretty much right halfway in between to where the market was. Well, actually, I'll show you a chart on there. Actually, let's go with that. And oops. So here you'll be able to see the chart. This should be the Dow. Primarily, you can see, I mean, this was over a 2-year period of time. We hit the highs. We had the dramatic sell-off. We had a bounce up. We stabilized, and then we bounced back up. The question is basically, how far is it going to go? Is this really going to be the beginning of the end? Now, there's really two ways of looking at it. This is a very detailed chart, so I follow the technicals quite a bit. If you know me, you'll know that already. So if we're looking at the technicals, we do have a pretty good bounce in the short term, and it looks like we will go back up and we will challenge the upward trend that we had. If we break up above that and we have a continuation, well, we might see higher highs coming up soon. And then in hindsight, this is going to look like a really good opportunity to invest and deploy some of your money. On the flip side of that, if the markets do bounce off of those highs and they start falling back down, then I'm going to be in the camp that this is the beginning of the end. Now, the thing to keep in mind is if you're looking at a longer term chart, if you're looking at a 10-year chart, even though we've had higher highs, if you're looking at it from a technical perspective, a lot of those highs have actually come in on worse momentum. There's been less and less momentum and less volume that was supporting the markets. So it's definitely going to be an interesting time. Over the past couple of weeks or so, we were hesitant. Anybody that came to us or that we were talking to that had money sitting in cash, we typically did not recommend that they invest that money, particularly in equities. And over the next couple of weeks, it's definitely going to be a telling time to really see where we're going to go. In reality, I think we're probably at the top of the ninth, to use a baseball metaphor. I'm not a huge baseball fan, but I think it's as good as a metaphor as anything, particularly when we keep in mind that the market has really been going up for the last 7 years, versus in reality, over a long-term period of time, we have a complete economic cycle that happens over a 7-year period of time, as opposed to what we've had now. We've had 7 years straight of growth. So that's pretty much that on as far as the stock markets are concerned. Today also we had the pleasure of having a late lunch with a colleague from Nuveen Investments. So anytime I can have lunch with somebody from the industry to kind of see it from their perspective, it's always helpful. Couple of takeaways that we had with that. At Nuveen, on the equity side, they do think that there's still really good valuations. They do still think that the market is attractive. The one thing that we'll keep in mind, a lot of the people who are in the industry of in the mutual fund industry, like Fidelity for one, I mean, they're what we call permabulls. So it's always a really good time to invest. And if you're thinking about it over a long period of time, that might be true. But in the shorter period of time, particularly if you're going to see more volatility, if you have money sitting in cash, it doesn't really pay to try to catch a falling knife. You want to see, and you want to pick up that knife once it's actually hit the ground. So that's on the equity side. Now, where we do feel fairly comfortable and confident in is the opportunities in municipal markets. So with the sell-off that we had after Puerto Rico, after the defaults in Puerto Rico, after the bankruptcies in Detroit, kind of like the baby was thrown out with the bathwater in the municipal market. So we definitely see a lot of opportunities in municipals on the taxable municipal side, but also on the high yield markets in munis. So even if the rates do start going up because of the Federal Reserve, there's still a large cushion there, and there's still going to be attractive opportunities in the municipal markets. Along the same lines, one of Nuveen's other entities, affiliate entities, they do see opportunities in corporate high yield bonds, once again, because we've had a sell-off. And typically in almost any run-up or sell-off, it gets overdone on the top or on the bottom. They had a couple of data points that they were sharing regarding energy play, particularly this person who they just joined Nuveen recently, but prior to that, they worked in the energy space. Couple of the fund managers at Nuveen, what they actually expect is over the next couple of years, we might start seeing a ramp up in solar and clean energy. Along the same lines, though, it doesn't mean that there's not going to be opportunities in the pipeline space. It doesn't mean there's not going to be opportunities in the energy space, particularly when we consider that the United States has a glut of natural gas to the point of that we're burning it off. And one of the interesting maps that was pointed out to me, there's an image, if you Google it, North Dakota at night, you can actually see right on the map at night where all the lights are. You see a lot of the lights located in North Dakota. And it's not lights because it's of industry. It's lights that the light is actually caused by the burning of natural gas. It costs more for some of the Bakken energy producers there to put it into liquid natural gas, ship it, and then resell it. So instead, what they just basically do is they just burn it off. So there's going to be infrastructure required to actually bring that gas to market. And like I said, the prices are really that low on this. So there is opportunity that's going to be there. Those are the big takeaways from there. The last one is actually, we're going to be looking at socially responsible investing. We do have a couple of clients who are looking for that. So Nuveen, which was just acquired by TIAA-CREF, TIAA actually has a couple of fixed income funds that are socially responsible. Now, one of the things we typically shy away from socially responsible type funds, and the major reason behind it is the performance is typically not there. By far, most of the quote unquote SRI funds have underperformed their peers, they underperformed the benchmarks, and in a couple of the funds that we did follow, which were the best of breed at the time, they've never really recovered to where they were even pre-2005. What makes this one different is this is one of the first bond funds, fixed income funds that invest along impact type investing, which basically it's socially responsible investing, but expanded out a little bit better. And this fund has actually outperformed a lot of the peers. So there hasn't been a penalty to investing in a socially responsible manner. So we are going to be taking a look at that. So if you have any questions, just feel free to contact us. We'll be able to go over that. So that is what we have. Next week, I'm actually proud that I will be speaking and participating at a couple of the panels at the ADISA annual conference in Las Vegas. It's always a really good opportunity to network with other colleagues and to find out what's happening in industry. And hey, it's great to stroke your ego a little bit at a time. So I'm thankful and blessed that I was actually able to speak and will be able to participate on a lot of those panels. So if you have any questions, feel free to reach out. We will not do an updates call next week. It might be in a newsletter because it's going to be a little bit tough since I might be traveling back at that day. But 2 weeks from now, absolutely, we will be doing this again. I hope you found us of value, and feel free to reach out if there's anything we can help